Welcome to my channel. My name is Mr. Cleophas. I teach at a regional college. A regional college is located in Commonwealth House in Moi Avenue, Nairobi City. And we are just next to National Archives, opposite Galitos Restaurant, or Galitos, which is in Moi Avenue. When you reach there, you can just look opposite. There's a building called Commonwealth House. So come to 50th floor, you'll find me there. And today, I want to talk about auditors' liability. And many of you, those who are in under section 6 doing, or those who are doing the advanced level, and maybe they are specializing in advanced auditing and assurance, or those who are also in section 4, which is the intermediate level, and they are also doing auditing and assurance. These are common area, these are common concepts, auditors' liability. And briefly, I just want to give a summary on how it comes, because it's, when you look at how the topics have been arranged, it is after reporting that the auditor can be held liable. That is, there is a topic called reporting, or audit reporting is also, it's in both section 6 and section 4, or the intermediate level and also the advanced level of CPA, and also other courses. Those who are doing their bachelor's degrees, they have also to know that the auditing can be one of their elective units. And I want to help my Kenyan students, those who are scholars in Kenya, those who want to understand auditing in details. Okay, I would like to just say, after reporting by the auditor, after he has given his audit report, and in that AGM where the financial statements and the report they are authorized for issuing to the public, auditor can be held legally liable. Auditor can be liable when he is doing the audit. Many people, they do not know whether auditor can be held legally liable, and this is found in a concept called expectations gap. Expectations gap is the difference in perception between auditor and the users of the audited financial statements and auditor's report regarding the audit of financial statements and the auditor's responsibility. What does it all mean? Some users, they think that the auditor's responsibility is to do what? Is to detect frauds and errors. While others think that the auditor's responsibility, when it comes to do the audit and maybe he gives an opinion, and which is maybe the qualified opinion, when they look at that opinion given by the auditor, if it is qualified opinion, they think that is the best opinion of them all, and which is not true. Even as per the standards, the ISA 200, auditor's responsibility is to express an opinion. But whenever an accountant looks at the auditor, they say that the auditor is coming to detect frauds and errors in the financial statements. That is just a secondary responsibility of the auditor. The primary responsibility of the auditor is to express an opinion on whether the financial statement audited gives or reflects a true and fair view. And because many people, they do not understand that, that is why we have the gap in between the users and the auditor. Auditor knows he has come to do what? To express an opinion. That's the main objective. Some users think the auditors come to detect frauds. Then again, auditor knows that that the qualified opinion is not the best opinion. But users also think that the qualified opinion is the best opinion. So there's a gap between auditor's knowledge and the user's knowledge. That gap, we call it expectations gap. It has got 3 elements. We have 3 elements of expectations gap. The first element of expectations gap is called the performance gap. So this is how the users perceive the auditor while he's doing the audit, he is underperforming. So it is the perception by the users of auditors for our report and the audited financial statements regarding the performance of the audit work. They look at the auditor and they see that the auditor is like underperforming. But auditor knows that he is performing his work accordingly and as required. So that is the performance gap. We have standard gap. Standard gap arises, or it is a situation where the users of audited financial statements, when they look at the standards, they see them like they are not covering what they should cover. Auditor knows that the standards are okay and they are covering what they should cover. And then the gap with respect to the standards is called the standard gap. We have the liability gap, which is the last one. That's why today I want to talk about the auditor's liability. I connect it with that. Liability gap, it is a situation where the users do not know whether the auditor can be held legally liable for negligence in performance of his work. And they do not know to whom can the auditor be held liable. So that is the liability gap. But the truth is that auditor knows that if his negligence in the performance of his work, and maybe he ends up giving an opinion which is invalid, that's what we call the audit risk, then he can be sued, he can be held legally liable for negligence. That's why under the auditor's liability, when you look at it, it says that auditor liability is divided into 4. Auditor's liability is divided into 4. It's good to know that. We have the first type of the auditor's liability, which may arise as a result of the auditor being negligent in the performance of his work. One is liability under statutory audit. Number 2, liability under private audit. Then number 3, we have liability to third parties. Number 4, we have criminal liability. The first 3, which is the liability under private, liability under statutory audit, and the liability to third parties, that one gives the auditors civil liability under common law. So if you are told to just explain the auditor's liability under common law, and then you are given some marks that is in either in advanced level of auditing, or in level, or in the section, in the intermediate level in section 4, which previously has been section 4, that is the intermediate level, then you should explain. The auditor's civil liability covers 3 types, which fall under the civil liability of the auditor. We have liability under statutory, liability under private, liability to third parties. It's important to understand now. I want to start with number 1, liability under statutory audit. It's important to know what is a statutory audit. A statutory audit, it is an audit which is legally required. When you're auditing limited liability companies, it is a professional requirement for each and every limited liability company, whether private or public, to have its books of accounts audited. That is as per the standards. So in such a situation, if auditor is negligent in doing a statutory audit, like the final audit we do for companies, then that is a statutory audit. There are some things which need to be proved for the auditor to be held legally liable under a statutory audit. So the following are the factors to be proved, or the matters to be proved for the auditor to be held legally liable under a statutory audit. Number 1, it must be proved that the auditor owed the plaintiff a contractual obligation. What does this one mean? It must be proved that there is a contract between auditor and the plaintiff, which may be the company, or could be the company, which has sued the auditor. So that's the first thing which should be proved. Number 2, It also needs to be proved that the auditor breached that contract, or auditor breached the contractual obligation owed to the plaintiff by being negligent. So auditor must have been negligent and he has breached the contract. That's number 2. Number 3, it must be proved that the plaintiff suffered financial loss. There must be a loss suffered for the plaintiff, for that company or that complainant to place a claim against the auditor. So those are the factors or the matters to be considered for the plaintiff to place a claim or for the auditor to be held legally liable under a statutory audit. We proceed to know the other one. But it's important to also know the ways of minimizing the auditor's liability, which I will also explain later as we proceed to the next. I'll do it at the last part of this concept. So just keep in touch, keep following, keep watching, that you get to understand. I want also, we talk of the liability under private audit. It's important to explain what is a private audit in the introductory part, in the intermediate level where you talked about the types of audits. There was also the private audit. A private audit is an audit performed to have an organization get the benefits of its books being audited. In short, it is an audit which is not legally required. Because if a statutory audit is one legally required, then a private, it is not legally required. It is an audit which is not legally required and is performed to have an entity benefit or enjoy the benefit of its books of accounts and financial statements being audited. E.g., an audit of partnerships. That is an example of private audits. They are not required by law to be audited. But now, if you want to know how the company maybe is performing, where the partnership is complying with the standards, etc., you need to have the partnership audited. Then that is a private audit. Then it's important to know for the plaintiff to place a claim against the auditor. In case of a private audit, the following or some of the matters which need to be proved, they're almost the same, or everything is the same as the matters which need to be proved for a statutory audit. We have said, number 1, also in this one, it must be proved that the auditor breached, number 1, it must be proved that there is a contract, or there is a contractual obligation between the plaintiff and the auditor, or the auditor and the plaintiff. Number 2, auditor breached that contract by being negligent. Then number 3, the plaintiff suffered financial loss. That is it. That is a liability under private audit. Sometimes in a private audit, you find that the scope is limited. The extent is the scope. The extent of doing the audit is the scope. Now, if the extent to which auditor is doing his work is being limited, either by management or by circumstances, then it means there are some procedures auditor will not be in a position to perform. And that leads to scope limitation, which may now affect the auditor's evidence. And due to that, sometimes auditors, in order to minimize this type of liability, may say, let me just have a disclaimer attached to the report or to the audit report to just reduce this type of liability which may arise due to successful claims by third parties or even by the plaintiff. Great, let's proceed. We have liability to third parties. The truth is, in common law, there is auditor, or for anyone to be held liable, there must be a contract. And the truth is, there is no contract between auditor and any third party, even the creditors. That is why when you're writing and explaining to the examiner, you need to just state the general rule. You say the general rule is that auditor is only or can only be held legally liable to a client with whom there is a contract. Then you can proceed and say, even though there is no contract between auditor and a third party, he owes them a duty of care. So, for the plaintiff to place a claim, that is for any third party to place a claim against the auditor, then the following matters need to be proved. Number one, it must be proved that the auditor owed the plaintiff a duty of care. This time is not a contract. No. To a third party, he owes them a duty of care. There is no contract. Number two, it must be proved that auditor breached that duty of care owed to the plaintiff by being negligent. Number three, it also must be proved that the plaintiff suffered financial loss. Number four, the financial loss suffered is material and quantifiable. It must be quantifiable. Number five, and the last one, the plaintiff suffered financial loss solely due to relying on the auditors and a true statement. Maybe in short or in simple terms, says the loss that was suffered was because the third party relied on the auditors, maybe reports or information which was untrue. Only that is the reason as to why he suffered the loss. That's why I say the plaintiff suffered the financial loss solely as a result of relying on the auditor's untrue statement. So that is the civil liabilities of the auditor. It's important to know the auditor's civil liability. Now, we have the criminal liability of the auditor. It's important also we cover the criminal liability of the auditor. Auditor sometimes he can just perform criminal acts. And the truth is, all criminal acts are punishable under the penal code. So what normally happens, this type of liability arises as a result of the criminal act that can be perpetrated by the auditor in the course of the audit. And as I've said, they are punishable under the penal code, and any auditor found guilty of any criminal act, he may be imprisoned and he will definitely be expelled from the professional body. It's important to know for those auditors, for those students who want to practice as auditors in the long run, that you are going to be expelled if you're found guilty of criminal acts. Auditors should be held criminally liable under the following circumstances, which I want just to highlight them briefly. One, if that auditor falsifies or is party to the falsification, that is giving wrong information. He falsifies or is party to the falsification of vouchers, books of accounts, financial statements, etc., etc., then that is a criminal act. It may result to punishment of the auditor, or auditor be expelled. So that is one of the acts which amount to criminal liability or criminal act. Another criminal act, if auditor fails to make material disclosures which he became aware of in the course of the audit, or which he became aware of during the audit of financial statements. If the auditor he just became aware and then he fails to make those disclosures of material matters in the financial statements, no, that is a criminal act. If auditor destroys vouchers, books of accounts, financial statements, etc., in order to conceal, to hide evidence, that one is an act which is criminal in nature. So those are some of the acts. Also, sometimes auditors may aid the client to make fraudulent entries in the financial statements. He maybe makes fraudulent entries, or sometimes auditor he also help the client to perpetrate illegal acts. E.g., he helps the client to do what you call money laundering. Hey, that is also another area or another act which is criminal in nature. Also, if auditor is found to be in total gross negligence while doing the work, while doing the audit, again, that is also an act which is criminal in nature. And that's those are the acts which can also, some of the examples of the acts which may lead to the auditor's criminal liability. Now, if you look at some of the questions in section 6 and section 4, they normally talk about ways of minimizing the auditor's liability. It is very important to ensure you know these ways. How do you minimize liability of the auditor? Okay, let me just mention some few areas here. One, you ensure you comply with the standards. If you want to minimize your liability as the auditor, ensure compliance with the standards. Number two, use of the engagement letter. In the engagement letter, it specifies what is your work. So it specifies what is your responsibility, the management responsibility, also the auditor's responsibility. So if you use an engagement letter and it clarifies such matters, then the client will know it is not your responsibility and primary responsibility to detect frauds, because you may be sued because you did not detect frauds as the auditor. But that is what's not the main objective of the audit. Your objective is to express an opinion. So use of the engagement letter also minimizes or reduces your liability as the auditor. Number two, you can also you ensure that you comply with the quality control standards. Quality control standards, they are the controls, or they are the policies and procedures put in place by audit firms to ensure that they give quality services to the client, and that the client gets quality services, and the work of or the audit work is done as per the standards. So those are the quality controls. Compliance with the quality control standards as per ISA 220. Great. Another one, use of a disclaimer, or you attach a warning to your report in case maybe for liability under liability to a third party. Auditor is required sometimes because of the scope limitation, and that's liability under private audit because of the scope limitation, to attach a disclaimer. So you can also attach a use of a disclaimer or a warning to stop reliance on the audit report by other parties in making their decisions. So those are ways. Also, sometimes auditors, in some countries, auditors or audit firms are required to register as limited liability partnerships so that they can prevent the wealth of the partners. Again, you as the audit firm, you can obtain what we call the professional indemnity insurance cover to transfer the risk which may arise from successful claims by third parties. This covers also all civil liabilities of the auditor. So obtain the professional indemnity insurance cover in case of any successful claim. Your firm will not be the one to pay the damages. The damages are going to be paid by the insurance company. So those are some of the ways of ensuring that you minimize the liability. Also, proper planning of your work. It's also another way. Use of the appropriate level of assurance. It's also